Hi guys, so today's video is going to be on debit and credit cards. This is all done in partnership with 50/50 Leadership. So credit and debit cards are both used to pay for goods without having to use checks or cash, but the money from each card is pulled from different places. So we're going to talk about Ella again, and we are going to be talking about how she would get money if she had a debit card or a credit card, and how she would be able to spend that money and where it would come from. So, what can Ella do with a credit card versus a debit card? With a credit card, the money is pulled from a line of credit or an LOC. And a line of credit is an account extended to you from a financial institution that has a preset borrowing limit or a maximum amount you can borrow from the bank. However, there are some disadvantages with credit cards. One of them is that you can potentially overspend because they're allowing you to spend more money than you actually have, and there can be penalties for late payment on top of the interest you're going to have to pay anyway. But debit cards are different. The money from debit cards is pulled from a checking account. So with debit cards, you're spending money you actually own. So checking accounts are deposit accounts with a financial institution. You can only spend the money you have, and you can deposit money by check, cash, or electronically through an ATM or over the counter at a bank. And with debit cards, there's usually no interest since you're pulling money that you already have. So, what other products do financial institutions offer? And these products can apply whether a person has a debit or a credit card. So, a savings account. A savings account is a deposit account at a financial institution that acts as a safe place to store your money in case of an emergency. However, some banks will limit the amount or the number of withdrawals you can make per month because banks will pay you a small amount of interest for keeping your money in the account. So it's like they're paying you or they're reimbursing you or rewarding you because you trust them enough to leave your money there. And we have a certificate of deposit on this slide. It is a savings product that allows you to keep funds at a bank for a predetermined time frame in return for a higher interest rate. And interest earned is usually higher than a regular savings account due to its time commitment. So because you're leaving your money in the bank and you're not touching it for a longer period of time, rather than a savings account where you can pull out money whenever, your interest is going to be higher, or your interest earned is going to be higher. The bank is going to give you more because you trust them more. And withdrawals are highly encouraged because it usually incurs penalty fees and reduced interest. However, if again you keep it and you don't take anything out, then you will earn higher interest. So yay, now you know all about debit, credit cards, a savings account, and a certificate of deposit. Good job. Thank you so much for listening, and please stay tuned for the next video.